So you're inheriting money and some of it sits in an IRA. Now, when inheriting money, it can be a really emotional time, and emotions can sometimes impact decisions. Now, when inheriting an IRA, it is a complex process, and when done wrong, it could potentially cost you thousands of dollars of your inheritance in unnecessary taxes. So today we're going to simplify the process, talk about what to avoid, and then the 3 options to potentially utilize when inheriting an IRA. If you're just joining our channel, my name is Scott Sierens. I run a retirement planning and investment management firm where we help families and individuals, people just like you, understand when they can retire, how much they can spend in retirement, how to minimize the taxes on their retirement savings, so that way they can maximize their retirement story. If that's an area that you need help with, go to lifemoneyshow.com and click on the Work With Us tab. So option number 1 when inheriting an IRA is taking a lump sum payout, meaning taking a big payout to your checking account. And for me, this is like a big red flag that goes up. Folks, in my opinion, this is a big mistake. You see, money in your IRA or in the IRA that you're inheriting hasn't been taxed yet. So every dollar that you're going to take out, if you take this lump sum payout, every dollar will add into your taxable income, and you're going to pay income tax on it. So if it's a couple $100s or a few $1,000s, it might not be a big deal, but let's just say it's $25,000, $50,000, $100,000, $500,000 or more. This could now bump you up into a different tax bracket. Maybe you're in the 12% bracket, it could push you into the 20-some% tax brackets. Maybe you're in the 24% bracket, this could throw you up into the 30+% tax brackets. For example, let's say you're inheriting $100,000, you're in the 12% tax bracket, but you decide to take this $100,000 as a lump sum. Well, this could mean the difference between you paying 12% over a certain period of time and inheriting $88,000, or if you decided to take one lump sum, now it jumps you up into the 22% tax bracket, and now you're only inheriting, say, somewhere around $78,000. As you can see, this lump sum can mean that you're actually paying unnecessary taxes on the inheritance. So just a little recap here. Pros, instant cash if you take the lump sum payout. But in my opinion, the cons way outweigh the pros here, is that you could potentially have a jump you into a higher tax bracket, and you might have a very large tax bill for taking that lump sum payout. So in my opinion, the lump sum payout here is a big mistake, but it happens all the time. So keep watching. There are better ways to inherit the IRA. Option number 2, if you're inheriting an IRA, is that you transfer it into your own IRA. Now hold on, there's a caveat here. You have to be the surviving spouse to be able to do this. If you're not the surviving spouse, if you're watching this video, you're not a surviving spouse, stick around to option number 3. We'll talk about ways for you to inherit an IRA that are more efficient than option number 1. But when working with surviving spouses, this is a way that we potentially utilize and consider a lot of times when working with a surviving spouse. So if your spouse had a 401k, 403b, 457, or rolled all of that into an IRA, you can take their IRA and then roll it into your IRA. You see, that's a non-taxable event because the money stays in the IRA account type. So some pros to this is, first off, that surviving spouses can utilize this option. Another pro is that the money stays tax deferred. So in option 1, when you take all of that money out, you're going to have that big tax bill. Option 2 here, the money stays tax deferred, meaning you only get taxed as you take the money out. Now, some downsides to this option is that, well, it is only available to surviving spouses. So if you're not a surviving spouse, you have to stick around to option number 3, which is a little bit different. The other downside is that when your spouse might have been required to take their RMDs, it might have been a little bit different than when you are required to take your RMDs, meaning you might now have to take the RMDs, required minimum distributions, sooner than otherwise planned. And sometimes your RMDs, because now you're taking RMDs not only for yourself, but also for your spouse, the RMDs might be larger than what you were expecting before. Required minimum distributions can a lot of times lead to a very, I'll say, surprise tax bill in your retirement. And I have a video on that to talk about required minimum distributions in your retirement. I'll link to it up above, as well as put a link in the description below. Before we get into option number 3, if you're enjoying this video, subscribe to our new YouTube channel, as we're coming out with new videos each and every week on topics like Social Security, retirement income, and minimizing your taxes in retirement. Option number 3 is using an inherited or beneficiary IRA. If you're inheriting an IRA and you are not the surviving spouse, this option is for you. A reminder, if you're not the surviving spouse, you cannot transfer it into an regular IRA. You have to start a special account, which is called an inherited IRA. Now, once you start your inherited IRA, you're then allowed to transfer the IRA of the deceased into your inherited IRA. That's a non-taxable event because it's going from IRA to an inherited IRA. You then are able to take the money out and pay tax as you decide to take it out. However, there's one special rule change to this that was part of the Secure Act, and it's called the 10-year rule, meaning you now have 10 years, or within 10 years, you have to deplete that account. And I can see what you're already thinking, wait a second, they're going to force me to take that money out. I am going to get forced to take it out over 10 years and pay the taxes on it. And that is a downside, but this is really where tax planning comes into place when it comes to inheriting the IRA. You see, for some people that we work with, we're going to spread that tax liability over those 10 years. We have other clients that we work with where they're approaching retirement. They just inherited this IRA. And instead of taking the money up front, we're going to wait till they retire. They've got lower taxable income, potentially a lower tax bracket, and then we're going to start taking that money out over those remainder years. The other thing to be aware of is for some of you, this inherited IRA account, you might be required to take required minimum distributions for it. Again, talk with your financial professional as well as your tax professional to fully understand your account and which tax planning ideas might be the best for your situation. As you can see, taxes will play a huge role in your future as well as in your inheritance. We have a free guide that might be helpful to you. You can download it at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. We'll include a link in the description below, but it's a free guide to unlocking hidden tax savings opportunities. Hopefully it'll help save you maybe hundreds or thousands of dollars in federal taxes when it comes to your accounts and your retirement. All right, really quick to wrap up on today's topic. If you're inheriting an IRA, don't make that big mistake of taking a lump sum payout. Really consider option 2 or option 3 when inheriting an IRA, as it might help you keep more of the inheritance with you and your family versus giving it to the IRS in taxes. Hey, I hope you enjoyed today's video. If so, subscribe to our YouTube channel. That way you get notified as we're coming out with new videos each week on retirement planning topics like Social Security, retirement income, and minimizing your taxes on your retirement savings.